Before we go into our interview today, I wanted to let everyone know we have a new sponsor for our Energy Question podcast, the U.S. Oil and Gas Association, or USOGA for short. First established in 1917, USOGA has been an effective and creative voice for the industry for more than a century now. USOGA is dedicated to educating the public, policymakers, and legislators at the federal, state, and local levels about the value of the domestic oil and natural gas industry. If you're in the industry and not currently a USOGA member, please consider joining the association as a way of helping it tell your story to the policymakers whose actions impact everything you do each and every day. You can start that process by contacting USOGA through its website, usoga.org. Thanks so much to USOGA for sponsoring the Energy Question podcast. And now on with our show. Hey, welcome to the Energy Question with David Blackmon. I'm your host, David Blackmon, and my special guest today is a return guest, Josh Young, the founder and CEO of Bison Interests, a really smart guy, one of the must-reads of my morning, every morning, as soon as I get onto Twitter, or I guess we're calling it X now. Some people are. I can't really get used to that, but I'm trying. But if you're on Twitter, you're not reading Josh Young's feed, you're really missing out just in terms of he always has great perspectives and information to share related to what's happening in the oil and gas and energy space. And Josh, thank you for doing our show again. Really appreciate it.
Yeah, thanks for having me, and thanks for the kind words.
And you just celebrated a wedding anniversary, right?
Yeah, that's right. It's I feel like there's so much sort of negativity sort of in the news and on social media, and so many sort of bizarre takes. It felt appropriate to share sort of a nice, positive, life moment that's, values affirming and just sort of nice thing to share. It doesn't all have to be doom and gloom. It doesn't all have to be sort of, hey, buy this stock and short this, and the economy's crashing, whatever other nonsense that you see on social media. So but thank you.
Well, that's wonderful. That's wonderful. I'm about to celebrate my 42nd anniversary here this month, and I'm really excited about that myself. Before we go into the Q&A, just remind folks what you do at Bison Interests, what your business objectives are, and how you run the place.
Yeah, and none of this is an offer or anything like that. Securities are highly regulated, and the goal of this is just to have an enjoyable, hopefully educational conversation. So at Bison, we invest in publicly traded oil and gas companies. We've been in business for about 8 years, and we manage money. We have managed money for endowments. We currently manage money for family offices and high net worth individuals. And we deploy money in a value strategy, sort of like a young Warren Buffett, where we try to find things that are really mispriced relative to their transaction value. And, in the over 8 years that we've been running Bison, we've done quite well. We're up over 100% over that 8-year period versus small cap oil and gas stocks being down about 70% in that time frame. So we've earned significant outperformance doing that. Again, this isn't a solicitation, just sort of an explanation of the background. And I think it's really important for some of the other stuff we're going to talk about. There's many people that prognosticate on commodities, on markets, on stocks. And I think one of the best things that anyone can do is to go and find the track record of those folks, both on their predictions as well as in whatever sort of their main business is, because I've found that success is sort of the best predictor. And that's one of the things we do, is try to find management teams that are highly successful with assets that are successful, and sort of bet on that continued success. And so I think it's really important in the context of policy analysis, economic analysis, financial analysis, and my assessment, to find people that have good track records. And that's, I think, a good reason to share sort of what we've accomplished at Bison.
Well, you mentioned Warren Buffett, so let's go there first. I was going to save that for later, but since you brought it up, he recently talked about his interest in, he's long had pretty significant positions in Oxy and Chevron, some other oil and gas companies, big shale producers in the United States. And he's talking about his desire to increase those positions now going forward. And I wonder, when you read that kind of story about Warren Buffett, what is your reaction to that? What are the factors do you think at play there for his desire to get even bigger into the energy space?
Yeah, so I was at the Berkshire Hathaway annual meeting, not this year, but last year, when they disclosed a significant addition to their Occidental Petroleum position, as well as, I think, a significant addition to the Chevron position. And this was very different from what commenters and followers of Berkshire thought would happen and had sort of guessed would happen coming into that. And so, and actually around that, I spoke at a conference or on a panel at a sort of meeting just outside of the Berkshire meeting with a lot of the Berkshire attendees, and they gave out $250 WTI oil hats. And so I wore my $250 WTI oil hat to this Berkshire Hathaway annual meeting, which was sort of this like almost like cultish gathering of tens of thousands of people who are, really trying to learn from Buffett, but also in many cases, for a lot of people, they almost sort of like quasi like worship him, right? They sort of allude to like the Oracle of Omaha. So here you had Warren Buffett buying huge stakes in oil stocks, right? That was sort of the biggest change in his portfolio. And people didn't even understand that I got no recognition for this 250 WTI oil hat. People didn't even know what WTI was. They didn't understand that this was this sort of astronomical, it wasn't, I didn't design the hat. I do think oil prices do eventually get to their all-time high. So the reason that matters is when you get back to sort of what's happening, people still don't understand what Buffett's doing. And most of Buffett followers don't want to bet on commodities. They'll tell you repeatedly, oh, we don't like cyclicals. We don't like commodity bets. We don't buy producers, all these endowment managers and family offices. Oh, that's not us. They'll worship Buffett and invest in Berkshire and invest according to Swenson, but they'll ignore what they actually do. So what is Buffett doing? Right. Buffett has created generational wealth in his oil and gas investments, right? Like not just as an overall generalist value investor, he's made enormous returns in his oil and gas investments. Yeah. What he said, which generally speaking, Buffett has multiple layers of sort of what he says versus what he actually means. What he said was, these stocks are very cheap and I'm buying them and the market's giving me a gift. What he also said in that meeting, along with what Charlie Munger said, is that we are running out of oil and we're running out of cheap oil, and that it makes sense to sort of go buy cheap stocks where the management teams are doing smart things like returning capital and investing in high return projects. And he sort of connected the dots between his purchases of Oxy in particular. He's actually subsequently cut some of his Chevron position, but continues to increase his Oxy position. And so, my takeaway from that is, I think there are great opportunities in oil and gas. I think that some of the best investors alive today are deploying capital into oil and gas. And when I look at what Buffett says also about small cap stocks and how if he were running $100 million today or $50 million today, he would be buying smaller cap stocks and have a much higher expected return relative to what he expects Berkshire to do, just given the size of the money he's deploying. My interpretation of that is, look, you can go buy Oxy for, let's say, 6 times 2024 expected EBITDA, or 12 or 15 times that expected cash flow for 2020, free cash flow for 2024, or you can go buy small cap stocks like we are at 2 times EBITDA and at, let's say, 3 or 4 times free cash flow. And young Buffett, I believe, would do that. And in the 50s and in the 60s, he did that. So there's the history, I think, informs. So I know that's sort of a little bit of a tangent and sort of a more complete answer around that question, but I think it bears watching closely when someone like Buffett gets heavy into a sector that most people don't associate them with and don't understand what they're doing beyond sort of a superficial level.
Well, that's always interesting, man. And he's been so successful with his strategies. It's always fascinating to me that he continues to hold these big positions in domestic oil companies, and I think it's a good sign for the health of the industry. I wonder what your assessment of the health of the domestic industry is. It seems, and I've written about this recently, it seems that they're pretty much in a sweet spot, particularly the shale people, in a situation where they don't have heavy pressure to really go drill a bunch of new wells, or at least any more than they need to maintain production. And they're really generating a lot of free cash flow and good returns to investors, paying dividends, buying back stocks. And I think most of the bigger companies, the corporations, are happy to kind of stay in this space for as long as they can. That's how it seems to me. I wonder what your perspective on that is.
Yeah, I think I think it needs to be said that the regulatory framework in the US is getting radically worse for business, not just for oil and gas. And I just don't think it's talked about. I guess it's considered politically incorrect. It used to be politically incorrect when the last president who did it because of his racial and ethnic background. Now it's just politically incorrect because, I guess all the media is left wing and just doesn't allow one to say this. But the regulatory environment is extremely onerous and getting way worse really fast. And that's very scary. And I think in the history of business and the history of economies, that usually is the lead up to really sort of scary, bad stuff from a market perspective and from an economic perspective. So it's worth saying that because what you're seeing right now is rigs dropping rapidly. But at the same time, the company's actually doing pretty well. And what you have is this weird, I sort of was joking about this on Twitter, where you have OPEC plus, where you have Biden essentially, they sort of stumbling into this because it does not look intentional, sort of forcing oil producers to produce less by making it so difficult to drill, so difficult to get permits, and people will argue about this and whatever, but it's just obvious. And when you look at any sort of specifics, the joke is that, about the Obama administration, the only people who thought that they were pro-business were people who didn't run businesses. Right? Like if you were an employee, you might have thought they were fine. But if you owned a business or ran a business or were responsible for a business, you knew it was terrible. They tripled the amount of regulation during the Obama years, and they're doing it right now at a way faster pace. Partly, I think they see the polls and that Biden's lagging substantially, and also his age and the unviability of his vice president as a presidential candidate. It needs to be said, right? Because this is something that's just not covered. And I think people don't understand there's not collusion between the oil companies. It's not like they're trying to keep their supplies down. They all want to. There's this sort of like burning desire to lose money by drilling uneconomic wells. Like these guys all love it. It doesn't ignore what they're saying. They love it. They want to do it, and they can't. And so, and they really can't. And it's not, they'll just point you to other stuff. They'll claim they're whatever. They really are having trouble getting permits. They're really having trouble maintaining their workforce. They're having all kinds of issues, and it's getting the trajectory of the regulatory onus is getting really, really bad. And you can also see it where when you look at Gulf of Mexico, offshore incremental activity versus offshore activity, offshore Brazil, West Africa, various other places around the world, you can see the impact of the regulatory burden where you're not seeing the same sort of uplift in activity in the Gulf of Mexico. And I think if you just take a second to think about that versus onshore, it's the same sort of problems, maybe lesser when it's not on federal leases, but the same sort of issue. And so I think when people think about, gasoline prices are going up at the pump, partly it's because of higher taxes, but it's partly also because of this regulatory burden. It's not that the oil companies don't want to adequately supply the market. From my perspective as an investor, they have this burning desire to lose money to oversupply the market always. And so
always, yes.
It's just ignore what they say, look at what they do. The same people are running these companies, and they've just done the same nonsense over and over again. And the government's preventing them from doing it. And that's why we have higher oil prices and struggling oil supply. And so, to the extent, the question is, hey, what are these big companies doing? That's what they're doing. They're really struggling to try to oversupply the market, and they're having geologic issues and they're having regulatory issues. And so they're sort of in this limbo, in this stasis where they're actually earning more profits than it seems like they would like to. And you can also tell from the composition of their boards and so on. I mean, governance is abysmal across public companies, but particularly in oil and gas, you have all these sort of people that don't belong on the boards who are there for sort of politically correct reasons or whatever, who are not dedicated to earning profits or delivering returns to shareholders. So again, and it's weird because I invest in this space, right? But I try really hard to focus on teams and on boards and so on, where they're very likely to actually do the right thing, or where they're just buyout targets. And so, they can have their 10-person board with their diversity initiatives and whatever nonsense unrelated to the oil and gas industry and still potentially do really well if they're at a large discount to recent transactions and if transaction values are rising in their areas.
Yeah, and to your point about the regulatory environment becoming impossible, I did an interview recently. I can't say who it was, but a CEO of one of the big contractors to the industry, not an oil and gas company. And I asked, is this administration, what it's doing, kind of harming your ability to have confidence in the predictability of the U.S. legal and regulatory system, which has been such an asset for our country in terms of attracting capital to invest in our economy, right? And he said, well, it would be really charitable to say it's doing damage. The damage is already done, and we have no confidence in terms of being able to plan our business, for years into the future. We have no confidence in the stability of the U.S. legal and regulatory system anymore. And that's not just something that, as you say, it relates to oil and gas. That's something that's impacting really every industry in this country. Nobody knows what the law is going to be or how it's going to be interpreted or applied by this administration. And when you can't know that, it becomes really hard to make these multi-billion dollar investments over 7 to 10 years, which you have to do quite often in the energy space. So it's a really big problem. I mean, I think you're absolutely right about that.
Yeah, and it goes downhill, right? It's not just the federal government that's doing it. As the federal government sort of misbehaves and oversteps its boundaries, local governments do too. With talking about Twitter, they rebranded it as X, and then they put a lit up sign at the top of their building in San Francisco, and the city of San Francisco freaked out. And the joke was, and they're assigning all kinds of penalties and fees. The joke was all they needed to do was make the sign out of heroin needles, and the city would not, they would just ignore it. And so, the lawlessness and sort of the perverse, selective prosecution, selective enforcement is really problematic, right? It's tough, and it's one of those things people think, oh, that's terrible to say about, drug users, that when they're violent criminals, they should go to jail because they have this thing wrong or that thing. The problem is when you don't enforce laws and when you selectively enforce them, you end up in a situation where it's very hard to deploy capital or to hire or to do various other things. And then, the cost to borrow skyrockets even for the federal government, which I know you had mentioned you were interested in chatting about as well.
Sure, yeah, and let's start. But one last point about that is San Francisco is a city that doesn't even police people defecating on the streets, but it's worried about the sign Elon Musk put up strictly for political reasons, and we all know that's true. Anyway, let's go to the Strategic Petroleum Reserve and the mismanagement of it by this administration. The Energy Department yesterday, the day before we were recording this, announced that it was canceling a contract to purchase 6 million barrels of oil after, it drew down the SPR to dangerously low levels, lower than any time in 40 years last year. So now they're making at least giving nods to maybe starting to refill it. And they had a contract for 6 million barrels. They canceled it yesterday at the same time or just after API announced a big drawdown in U.S. Stocks. And then today, of course, EIA announced an even bigger drawdown, 17 million barrels for the previous week. I wonder if you think there's a cause and effect relationship between those events, that the big drawdowns in stocks convinced DOE that maybe this isn't the time to be buying oil and putting it in the SPR.
Yeah, I think the way the SPR has been managed recently has been astonishingly sort of scary and bad. The goal of a strategic resource or reserve is to use it strategically, not for your personal reelection as a politician, but to use it for the benefit of the strategic position of the country. And so, here we are in this situation where, there's elevated geopolitical risk to oil supplies from Russia and other sources, where we're doing these weird deals with Iran and Venezuela, who are our enemies, and in some cases fund violence against our citizens and against our military and strategic interests. We're funding them. And, it's just so strange to do that and dump our Strategic Petroleum Reserve like we did and not refill it when prices fell subsequent to dumping it, and then to again raise this regulatory onus, lower the boot of government on these producers. It's sort of like if you looked at how do you damage the US strategic position most, this is one of those things where it would be hard to come up with a path that you'd be able to execute on that would be more destructive to U.S. energy security than this path. And there's people have trouble saying that. They talk around it or they deny it, their political affiliations or whatever. Look, I would hate this if Trump did it. I hate it that Obama did it. I hate that, with his regulations. I hate that Biden's doing it with dumping these reserves. It's just wrong. And it's not about whether I make more money or less. Frankly, I'm making more money from all of this, from this mismanagement. And
Right.
oil prices are likely to go way higher because of this. I'd rather not. I'd rather make money from stock selection and just sort of normal course of business. But there is a reality here, which is, just horrible mismanagement. Oil prices did fall after the reserve was released last year. And so there was this idea that, hey, Biden was this great oil trader, but he didn't refill it. So he's not. And I don't know that he'll ever really refill it. And there may have been damage from withdrawing as much as they did. So it's really, I think it requires attention, and it deserves words and scarce time and resources dedicated to this, because it's so bad. And there are many people who risked their lives, and some people who lost their lives to defend the US, to defend what we stand for. And it's really just so shocking and awful to see it, just that sacrifice wasted and given away essentially for minor political gain between two political parties.
Just really minor and really the wrong reasons to even be talking about the SPR. It's as you say, it's there for strategic purposes, and $4 oil prices is not a national emergency. And the time to refill it, of course, would have been earlier this year when oil prices were low, and you had an opportunity to buy low. Now, over the last month, in the month of July, oil prices jumped up by 15%. WTI, as we're recording this, is over $81 again. It was as low as 67 recently. And, the administration had a real opportunity to buy low. And now prices are back higher. And it seems as if to me anyway, and in my way of looking at things, it seemed like the July price increase was mainly related to the latest round of cuts mainly by Saudi Arabia and Russia, but also some other OPEC countries during that month. I wonder what your view is, and where you see, do you think the market is actually, given these indicators we've had this week, is the market undersupplied right now?
So the weeklies are totally unreliable, both from API and EIA.
Right.
Unclear exactly what the problem is specifically. There's been sort of different problems, and at some point you just say, hey, this is not, it's fun to watch. Totally. I've been joking on Twitter about bearish draws and bullish builds in these weeklies, because it's just nonsense, and the market tells you it's just not, it doesn't mean what you think it means.
By the way, my favorite part of that is everybody thinks you're 100% serious when you do that, and responds with these crazy responses you get is totally hilarious. Anyway, go ahead.
Yeah, but again, the point is, it's sort of funny, but also sort of sad, right? Like the point of government collected and reported data is for people to have accurate information to be able to make business decisions based on, in order to promote stability, which promotes employment. Here we have the Fed trying to kill employment. We have regulators increasing instability, and then data providers that are providing unreliable data. And so the big news was not this weekly. This weekly is irrelevant, just like every weekly is irrelevant. The big news was the restatement of May demand up. I think they restated up 900,000 barrels a day for oil demand. They restated oil supply down by a little under 100,000 barrels a day. They restated NGL supply, so natural gas liquid supply, up 400,000, but still huge restatement that was very bullish. And weirdly, these weeklies get way more attention, even though they're sort of, just throw a dart. And it's a little better than that, but not a lot. And they're really confusing. And, I regret, I think a couple of years ago, I was sharing these and talking about them. I didn't think they were that meaningful then. They're really not meaningful now. The data quality is maybe even worse now than it was then. But again, this sort of thing, it leads to instability, which leads to less capital investment, which leads to less supply, which leads to higher prices. So when you think about all this stuff, OPEC is cutting because they were worried about weak demand, and there was weaker demand in China and Europe than people expected. But demand in the US has actually been strong, and global demand has been pretty good. I actually don't think OPEC needed to cut. we already were in a deficit situation for the second half of this year on a consensus basis. That's not sort of a unique Bison thing. The consensus was a 2 million barrel a day deficit before this million barrel a day.
Right. It almost seemed like they were panicking when they did that to me, but I'm no expert.
I don't know. I think they just wanted to make it very, very clear that there was going to be an undersupply in the second half of this year. And they were very clear. And the weird thing was people reacted, like you said, where they thought, oh, they're panicking, therefore it's bearish. And the reality is they just thought the narrative was wrong. They probably saw the same numbers that we're seeing and everyone else was seeing. I mean, when the EIA and the IEA both forecast a 2 million barrel a day deficit, these guys always understate demand and overstate supply, or almost always. Over the last 8 years, I think it's like 95% of the time.
It's phenomenal.
Yeah, not 100%, but almost always. And so, I mean, why would you cut supply into that? And everyone misinterpreted that, like the world is ending, and the world was not ending. They just were annoyed about this nonsense, and they wanted to just make it so obvious that the world was going to be undersupplied that it would be clear to everyone. And the weird thing was, it was non-productive, right? Like people just took it the wrong way. Now it's helpful that there's giant draws, but then it's also unhelpful because now there's more spare capacity, at least in the short term. And so in theory, they could turn back on oil, which is actually bearish. And so there's some complexity. And then the big thing there that's really interesting is they've been starting to hire these rigs from places where they don't belong in the Persian Gulf, right? If you're pulling a jackup rig from the North Sea and you're sending it to the Persian Gulf, there is something wrong. And we're starting to hear reports. So one of the nice things, we put out this analysis of OPEC Plus's spare capacity a couple of years ago. And one of the nice things about having done that is we get some inbounds from engineers and service providers and others in various places to help us understand what's actually happening. And we're starting to hear some very concerning things about watering out and other issues in Saudi Arabia and Kuwait. And so we're here. I mean, these are things, they will not say it, but these are consistent with spending lots of money on rigs at, the rigs that don't even fit for why do you need a high spec, harsh climate rig in the Persian Gulf where there's almost no waves and it's certainly not freezing. And then when you look at just the number of rigs that are being used and the activity, it's not, people have this idea that it's like the Beverly Hillbillies, you shoot the ground and oil spurts out. And the cost curve in Saudi Arabia, it looks like, and Kuwait, and maybe some other spots, actually is way higher. So they have a non-economic reason potentially to be cutting back on supply, which is to sort of reconstruct, to give their fields a little bit of a breather, to pump more water down, maybe some surfactants, to sort of figure stuff out a little bit. So this actually may not 100% be economic. And again, we're hearing that from multiple different sources that sort of form a mosaic that indicates that there may be real supply problems, at least short term. They're solving it through just throwing a lot of money and drilling a lot of wells. But it's worth noting, because when people behave like you're saying that are indicate panic or indicate whatever, sometimes it doesn't actually mean what you think it means. And so, I think there are multiple drivers for their decision to cut.
Well, we'll have to keep an eye on that. I knew Matt Simmons, and this watering out you're talking about was exactly what he was predicting, although he predicted it much sooner in his book, Twilight in the Desert, that was published in 2004, I think, 3.
Have it on my shelf back here. So
he's one of these peak oil guys who was wrong, in real time, but maybe he was just ahead of his time. Anyway.
If you think about that sort of phenomenon, that's not something, it's sort of one of those things where you can predict an earthquake in Southern California, where I'm from. And you're going to be right. It's just a question of time. So it's one of those things where he was making a geologic, essentially an engineering prediction, and he was totally off. I mean, they did some re-engineering, right? So he was off on the impact of the re-engineering and the technology improvements and so on, but he wasn't wrong that there is a limited amount of oil down there. And over time that gets depleted, and that the requirements of the technology improvements rise more maybe than they can actually deliver over time. And again, that's evidenced by the activities that Saudis are engaged in. If there was all this oil in Ghawar, why on earth would they be spending hundreds of thousands of dollars a day per offshore rig to go drill offshore? Like, if you have all this oil, why do you need more?
That's a good question.
I mean, it seems very simple, but also sort of obvious that that would be the case. And then it's just a question of degree and deliverability. And then when you see something like a non-negotiated additional temporary cut, I think you really have to look closely, because I think there's a decent chance that that's actually not economically motivated. That's engineering motivated, geology motivated.
Yeah.
And again, like the market is more than balanced. We're seeing draws. Any weekly draw I wouldn't read too much into, but that restatement for May, when you project it forward and look at job numbers and GDP numbers for the US and so on, I mean, that it looks pretty positive for a demand perspective. One other thing, freight activity, we predicted this or observed this in May, that freight activity in the US was bottoming, and we're now starting to see some of the freight specialists, we discovered it has bottomed. The green shoots. It's like, guys, like you could see the chart had sort of come down and was flatlining and was starting to bump around. That's what you look for sort of bottom and a potential recovery. And things had gotten so bad for freight that we finally, we figured, hey, this is sort of about as bad as it's going to get. We're starting to see green shoots, so additional truck activity, additional rail activity, and that's very positive from an oil demand perspective, because diesel has been a global weak spot. And as we see increased trucking activity, they're trucking something, right? They're trucking goods in some cases from China, right? So that's increased manufacturing. That's going to be increased diesel consumption and other consumption in China. And it sort of fixes a lot of this problem that people have been observing. And it's going to mean probably much higher actual demand numbers for June and for July than people were projecting.
Oh boy.
Potentially way higher demand again, absent some sort of big event. And we may be in a big event right now. It's unclear, but treasuries are down 4% in the last 2 days. The long bond, which is the opposite of what most macro forecasters were predicting. I didn't predict this, but a couple of my close friends were on it. They were like, hey, this is going to happen. Or a high probability of happening. And I think, there is a risk that we have some sort of big event where we miss some of this forecast demand, but at least for right now, things look really good from a demand side and insufficient from a supply side for what.
Well, I got one last question. We're up against time, but Fitch downgraded the U.S. credit rating the day before we're recording this. What do you think the impacts of that could be on us?
Yeah, so Fitch downgraded in my assessment because price moved. So the analysts always follow the price drives narrative. So the price for these 30-year bonds and for TLT, the sort of ETF, which by the way I own some put options on in a small sort of hedge position. It's important that I disclose that, and I'm not recommending that. So the price fell for bonds, and then the ratings are falling, which is what you see for stocks, right? Stock prices go up, analysts raise their target prices. Stock prices fall, analysts lower their target prices and lower their recommendations. Same thing for bonds. The price is falling. Why is the price falling? Because we're in a giant deficit and we're sort of mismanaging the economy, and the Federal Reserve is sort of messing up, and we're in this sort of just weird position where many people were piling into bonds because they were told to by their financial advisors. They were told to by XYZ forecaster that they're paying all this money to for nonsense subscription services that are sort of just ripping them off or whatever. No one knows the future, right? But you can sort of understand positioning. And the positioning was very, very far towards too many people owning 30-year bonds out of a concern of a financial crisis or a concern of an economic slowdown. As that hasn't happened so far, as well as there's more issuance by the Treasury to fund this giant deficit for these programs that burn money and create very little value. As that happens, there's increasing risk of bond prices collapsing and yields skyrocketing. And again, I don't know that will necessarily happen. I just have some insurance essentially in case we see a really big move in these long bonds. But the thing that you can easily observe is positioning, and everyone owned these things. They were very, very heavily owned, and many people were recommending and owning the short-term bonds as well. The money market ownership and stuff has skyrocketed as well. And when everyone owns one thing and no one owns the opposite, and it seems crazy to even talk about the opposite, that's a time generally in my experience when the opposite gets really interesting and compelling. So Fitch is just following the price movement. The price sort of told you what Fitch and others would do, and it's not nothing. It's a really big deal. And again, it sort of ties back, and this is sort of the last comment for this, and I appreciate the time. When you have bad policies, they lead to bad outcomes. And the worse the policies are and the worse the regulations are, the more risk of a extra bad outcome. And seeing treasury bonds sell off like this, it's a signal that we may be in for a particularly bad outcome from these failed policies. Maybe it's way higher oil prices. Maybe it's just bond prices crashing and bringing down a stock market and, sort of triggering some other sort of crisis. Maybe it's something else, and maybe it's nothing. And hopefully it's nothing. The GDP is strong.
Yeah.
So, I'm not a doom prophet or anything like that, but this is a large move in the 30-year rate over a very short amount of time. And, TLT broke under 100. It's down to, as of this recording, I think 96 or so in 2 days, which is an enormous move for securities that are essentially expected to have almost no volatility. And they're supposed to be risk-free. So that's a really big deal. These are government bonds, 30-year bonds. They're supposed to be pretty, safe. And if there's a downturn, they're supposed to provide you protection by trading up quite a bit. And that's not happening right now. And it's worth focusing on. And there is this left tail risk from the price movement. And again, the Fitch thing, it's just letting you know, if you weren't following the price, that this is happening. And, potentially, hopefully nothing more on this, but there is the potential for more to come. And it's scary. And I think it's worth watching.
Well, now folks, why you need to follow Josh on Twitter and everywhere else he is. This kind of insight is not something you can get from just anyone. Josh, thank you so much for being my guest again. Let's do it again here in a few months and see where we are closer to the end of the year.
Great. Thanks a lot, David. I appreciate it.
All right. And thanks to the Sandstone Group for hosting our podcast, and to the U.S. Oil and Gas Association for being our sponsor, and to our extraordinary producer, Eric Perel. I'm David Blackmon, and that is all for now.